On Monday we finished chapter 10 and we got about halfway through chapter 11. We talked about, actually we did, yeah. We talked about the premium tax credit, which is actually a refundable credit. Then we talked about all the various non-refundable credits that we would find on page 1 of Schedule 3. We didn't talk about them all because some of them are pretty rare, but if you look through the tax form, it'll give you some ideas of other credits. Most of them won't apply to many of our clients, but that'll just give you an overview of credits that are available. And then today we're going to go on to the refundable credits that are available. So these are all on page 2 of Schedule 3. Before we begin, do we have any questions left over from Monday? Okay, if not, our first, let's see, we already talked about the net premium tax credit. And then line 10 is going to be amount paid with request for extension to file. And that's going to be, I think, in chapter 19, when we talk about filing extensions and deadlines and stuff like that.
The net premium tax, that was that energy credit, right?
No, premium is health insurance, healthcare coverage. So there was premium tax credit and advanced premium tax credit. And if your premium tax credit is more than your advanced premium tax credit, the difference is your net premium tax credit, and you get the excess as part of your refund. It's treated as a payment. Yeah, and then we have only 8 classes left. There's today and Friday. There's 3 classes next week, the 3 classes the week after. So November 17th, that Friday, will be the last one. So, and we have 9 more chapters to cover after this one. So I'm not sure how exactly that's going to work, but we'll try to do our best. Okay, so the next credit that we need to talk about today is the excess Social Security and Tier 1 railroad tax withheld. And what this is there's a certain amount of wages after which you're no longer required to pay Social Security tax. And we're on page 366 if you want to follow along. That limit is in 2022 was $147,000. So if you earn more than $147,000 in wages, after that point you no longer pay Social Security tax. There's no similar cap for Medicare tax though. You keep paying that 1.145% no matter how much you earn. However, if you have more than one employer, each employer is required to take out Social Security tax, which is 6.2%, up to the full 6.2% of $147,000, which comes out to $9,114. So if you work for more than one employer during the year and you make more than $147,000, each employer is required to withhold up to $9,000 in Social Security tax. You end up, in that case, paying more than $9,114, in which case you can get the difference back. So for example, if you had one employer, you made $100,000 at that job, and then you changed jobs, you made $100,000 at your next job. 6.2% Social Security tax, you would have paid $6,200 to each employer, which is a total of $12,400. And $12,400 minus $9,114, you would get a net. You've overpaid into Social Security tax by $3,286. And so that difference will show up here on Schedule 3 as excess Social Security and Tier 1 railroad tax withheld. This amount is calculated separately for you and your spouse, even if you're married filing jointly. And this does result in some errors that are easily fixed. If both spouses, for example, work and they each make $100,000, there should be no excess Social Security tax because they're both under the $147,000 limit. But if you're doing a tax return and you accidentally code both the W-2s as belonging to the same person, the tax software will take you at your word and it will assume that one person has worked both these jobs and has paid too much Social Security tax. So it is important that if you're doing someone else's tax return or doing your own, that as you're entering W-2s, you make sure that's associated to the correct spouse on a married filing joint return.
But if say one person makes 200,000, right?
Mm-hmm.
So they've gotten way over the normal amount for Social Security, and the other spouse doesn't work.
Mm-hmm.
Would they be just counting the Social Security on one, and the other one basically doesn't have any due?
That is, yeah, it's based on each spouse, each individual person, and not on the joint return.
Okay, so if one basically had no work wages to withhold Social Security, or doesn't owe any Social Security, then his surplus doesn't go towards the other spouse.
No.
The other one doesn't have any due.
Right.
Okay.
Yeah, so if you had one spouse with two jobs that both made 100,000, they would get that 3,200 credit for excess Social Security tax. Whether they're married, filing jointly, or single, or head of household, it doesn't matter. Okay. Let's see. If this is very similar to how you may pay excess Alaska unemployment tax during the year. I believe the unemployment tax cap for 2023 is based on 47,000 in wages. I think it's 0.53%, but I'd have to look that up to be exactly sure. But basically what that means is if you work for more than one Alaska employer and you made between those jobs more than 47,000, then you overpaid into unemployment. And we did an example of that way back, I don't know if you remember, but it was about 6 or 7 weeks ago. We did an example of someone who overpaid into Social Security, not Social Security, Alaska unemployment tax, and got that difference back. You cannot take this credit if you only had one employer. So if you had one employer and they took too much, then you have to get that back from that employer.
But if someone's self-employed and they made more than the 147, then they simply would just have to pay that and just up to the max, right?
Right. Once your wages plus your self-employment income hits that same limit, you stop paying Social Security tax on your self-employment. So if you work at, if you have a job and you're self-employed and you're already at your job, say you're already over the $147,000 limit, then you won't pay any Social Security tax on your self-employment income. Okay, so the next credit, refundable credit we have is the credit for the federal tax on fuels. And this is claimed on Form 4136. And what this is you are, whenever you buy gas at the gas station, part of what you pay is a federal tax on gasoline. And there's also a federal tax on diesel fuel and aviation gas and kerosene also. And that tax for gasoline, excuse me, is 18.5 4.3 cents per gallon. So do we have any more information here? And that money is supposed to go toward maintaining our highways. Similarly, you have tax on diesel fuel, and if you buy diesel fuel at the gas station, you're paying 24.3 cents per gallon tax. That's included in the pump price. You won't see that noted separately. If you're using that fuel for some business purpose that does not use the roads, then you can get a credit for the tax you paid on that fuel. So, for example, if you have a farm truck that you only use on your farm and you never drive it on the roads, then any gasoline you put into that truck counts as qualified non-taxable use. And you have to keep track of how much gas you put into that truck, but you'll get a credit for 18.3 cents per gallon that you put into that truck.
Does that count for like chainsaws and stuff too, or?
Yes, yep, this counts for any non-road use of gasoline, but it also has to be business related, so you can't just say, oh, I put it in my lawnmower to mow my own lawn. That doesn't count. But if you put it in your lawnmower and you are in the business of maintaining other people's property, that's also a non-taxable use of gasoline.
So if I had to go cut a tree on the lake, I could use it on my boat?
Mm-hmm. Yeah. So you have to keep track of how much gasoline you actually use for that purpose, and you get 18.3 cents refundable credit for that purpose.
What, does boating, I guess like these charter boats, are they essentially getting a deduction for all of their gas that they spend on their marine engines? I mentioned aviation, off highway and such, but
I think there's
I mean, it is off highway.
I think there's some sort of like marine tax, because they have pumps down in the water and stuff too.
I mean, for gasoline, I guess it could be used off highway A or C.
Well, not sure.
So for that purpose, they just need to keep the receipts and primarily have the total number of gallons.
Yes, you have to keep your receipts and keep track of the number of gallons you've used for this non-taxable use.
And then I take it this probably doesn't count for personal boating, right?
Right.
No, it has to be.
Yeah, this has to be off-highway business use, so on a farm for farming purposes. So there's 16 types of uses that you would have to put in one of those codes under column A. So we have on a farm for farming purposes, we have off-highway business use, so that would be like your chainsaw, your lawnmower. Let's see. So yes, it looks like a boat engaged in commercial fishing. That is also a non-taxable use of gasoline or diesel. Then there's also like school buses and government transportation, things like that. There's also dyed and undyed diesel fuel. So diesel fuel may have dye in it. I forget what color it is. I think it's pink.
Red.
But that is it red?
Untaxed. Untaxed is red, and then clear has been taxed.
Right. So if it's red, that means it's not been taxed, and you're not allowed to use that in in a highway vehicle. So if you're, that's one thing. If you have to stop at a weigh station, they may test your fuel tank and might put a dipstick in there. And if it comes out red, you're going to get in a lot of trouble because you haven't paid your fuel tax on that. But if you pay, you can use undyed diesel fuel for like home heating or any other non-highway use. And then you don't pay the extra 24.3 cents.
So is home heating one of the things on here?
No, it's not. No, you only get the credit for tax paid on fuel for some business purpose.
So at that point, the fact that you're buying it as heating fuel would be up to the local sellers.
Mm-hmm.
Selling heating fuel.
Yeah, you should be requesting undyed fuel, diesel fuel, for using diesel fuel to heat your home.
If you call like Crowley or something to get fuel delivered, they ask if it's heating fuel or not, and they'll give you the heating fuel at a cheaper price.
Mm-hmm. I don't know what this Form 2439 is, and the book doesn't really tell us much about that, so I guess we can more or less ignore that. And that's it. I guess there's only those two refundable credits that we want to talk about at this time. Might as well talk about some of the other ones that are on Schedule 3, at least as far as I'm familiar with. Let's see. So B is credit for qualified sick and family leave wages paid in 2022 for leave taken before April 1st, 2021. So that's not going to apply in 2023, so we can ignore that. We have a credit for repayment of amounts included in income from earlier years. That is something we talked about before. Does anybody remember what that is? Okay, that is if you paid taxes on money that you were that you thought you earned, but then you had to pay it back, and that amount that you had to pay back was more than $3,000. You can go back and use your older return as a worksheet to figure out how much lower your tax would have been if you hadn't paid tax on that amount. And that difference in tax you can take as a credit for repayments. So the example I used was, or the most typical example actually would be if you over collected on unemployment. So let's say you got 21,000 unemployment in 2022, but in 2023 you had to repay 5,000 back to the state of Alaska because it turned out you were working and they wanted their money back. You still have to pay tax on the whole amount in 2022 because that's when you received it. But in 2023 you get a credit for the difference in tax on that extra 5,000.
And only if it was more than 3,000.
Yes, only if it's more than 3,000.
What was the 3,000 rule again?
If the amount you repaid was less than 3,000, you get no credit, period. If the amount you repaid was 3,000 or more, then you'll be able to take this credit by recalculating your tax from the previous year.
So it's under 3,000, even though you paid a surplus of taxes on it. That's
It's
basically
got,
your problem.
you lost it. Mm-hmm.
Okay. And that only applies if it was 2 separate years, because if it was the same year, then you just get a net.
Right. Mm-hmm.
Okay.
Yeah. Another example where this happens, I haven't seen any of our clients in this situation, but I have seen a lot of people ask this question online, is maybe you get a signing bonus. So you say, your employer to be says, you know, if you start working for us, we'll give you $10,000 up front as long as you stay with us for at least 2 years. And then after 18 months you quit, and they say, well, give us back our $10,000 because you broke that deal. That would be you still have to count the 10,000 as income in the year that you received it, and then the year you paid it back, you would get a credit for what you paid back.
Do you know the employers face that a lot, where they can't get people to pay back their signing bonuses and such if they leave early?
No, I don't know. I don't actually know any employers that do that.
That happened, we had one this year.
We did.
Where that happened, she got a signing bonus on her first check, but then then they moved within the year. And they got their money back, is that like their last checks or whatever, they just took it out. But she also paid FICA taxes on the signing bonus, which I'm trying to figure out if they actually gave her credit, or, because she had to pay the full 10,000 back to the company, but she didn't actually get it because they took taxes out.
Yeah, you actually have to file an 843 to get that. Let's see. This is 13E and 13G are reserved. We'll see boxes like this where they're blanked out because they might have been used in a previous year and then that particular credit or item was repealed or disappeared. But they don't want to keep renumbering and relabeling everything. So they want like 13D to continue to be 13D. So they'll just skip that line. So that's why we have these blank lines. 13F has something to do with repatriation of foreign assets. Oh, your cat's here, Eric.
Oh, we just took off.
And yeah, both 13B and 13H have to do with sick leave credits for during COVID. So those are no longer applicable. And I don't know what else would go on 13Z, but if you look at the actual publication 17 or the 1040 general instructions are a lot more in depth on all the things that you could end up claiming on something like this. And then we could talk about due diligence again, but because we're short on time, we'll go ahead and skip that and move on to our.
He took off.
He curved up on there, so he might have turned in again, or just took off altogether.
No, he took the road.
But he was on caught a loop there.
All right, let's go ahead and review our classwork starting on chapter 11. There's 2 questions, so maybe we'll work on these as a class. So a single taxpayer may not claim the retirement savings contribution credit if your AGI exceeds
34,000.
sounds right. Let's see. Yeah, 34,000. That's where it becomes 0 if you look at the chart on page 352. And then number 2, a taxpayer may claim a credit for prior year minimum tax. The answer, well, we don't really care that much about minimum tax, but the answer is going to be if your current year AMT is less than your regular tax, and you paid AMT in the previous year. So it's going to be, oops.
F, B, and C.
Yeah. Yeah, B and C. There's more requirements than just those 2 though, but we don't really need to worry too much about minimum tax.